Well, guys, I've just been kind of faffing around. I'm trying to get like the right thing to show you guys. But here we're talking about what is going to go on right now. We have a US jobs report. Ideally, we want the jobs to come in pretty much on target. If they come in lower than expected, i.e., less jobs, let me just bring this up so we can kind of add a little bit of perspective to it. So we are anticipating 200,000 new jobs added. Okay, and this is without the farming sector, and I believe a couple others, but generally they put that as the non-farm. So we're looking at kind of corporate jobs and things like this. Okay, so 200,000 new jobs added. That is the current forecast at the moment. We want unemployment to be at around 3.7. If we come in below, so if we have, let's say, 190 thousand new jobs added, this is going to make the Feds be like, okay, well, we are restricting employment, which is a good thing, right? That's one of the leading indicators, well, maybe lagging actually, but you can look at it both ways. And so this is going to give the Fed a good idea as to how strong are they being, how successful are they being in actually squeezing down the market. And I realize I need to bring myself down here and move that around for you. So this is, as you can see, 200,000. This is going to give the Fed a really good idea that, hey, hang on, what we're doing is right, okay? And we want unemployment to be higher. This is going to allow the markets to pump. But overall, we're not really. I don't know how well we're going to see this, because it's bad. Like we're going to head for unemployment, but at the same time, there's a lot of indications that actually show us that we're in for some pretty bad scenarios. Actually, what I will do, let me bring this up. I'm going to bring it up on my phone, guys, so that you can all hear it. Because when I play it from my computer, it just doesn't work. So look at this. I'm technical wizard. I am right here, right? I'll go full screen on this. We'll mute this, and then we'll get this up live. Bloomberg surveillance. Hit me up, baby. Here we go. So we should all be able to listen to this. There's a 15-second advert here about Patek Philippe. Great watches. I absolutely love them. My friend bought one the other day. Looks divine. If you guys don't know about Patek Philippe, you should. They're gorgeous. But they're watches, Niche. Very niche. Another thing though, actually. Okay. All right. Here we are. This is not quite okay. So Canada. Let me pause this for a sec. I want to try and get it to line up. What's going on? This is like the most important thing. We're going through the jobs report, and Bloomberg's just showing me random stuff. Okay, I think we can hear. Right.
Seconds away going into it. Futures never 2/10 of
Let's go.
Well, the whisper number was wrong, John. 263,000 jobs created in the month of November, so a significant beat to the upside. Even the forecast was 200,000, and that puts us at this point ahead of. I'm just looking here.
A lot of jobs
for what the revised monthly October number was, but it was 261, and the change for October was revised up by 23,000. 261 to 284. So yeah, job growth slowed back in October than we thought.
Yeah, so the overall overview here, guys, is if they anticipated 200, now we're seeing still with lots of companies hiring. We have seen the likes of Google, Facebook, a lot of these tech companies all just say, actually, we're going to, fire like 1,000 people. But it's just not enough. We're still seeing quite a high ratio. There's a 1.7 to 1 ratio in terms of 1.7 jobs available for every one person that wants a job. And that's not good for the Fed.
That's what everybody cares about. That 1,000 job loss in manufacturing in the ADP report does not translate. 14,000 jobs created in manufacturing. Earnings, this is the one Lee said I've been looking at. up 0.6. That is stronger than anticipated, stronger than the 0.5 in October, and that pushes up average hourly earnings year over year to 5.1%. 5.6% is actually the revised number for October, so it's a decline, but it's significantly higher than it was in the initial report. I'll give you the labor force.
Right, this is the gap down.
It drops to 62.1. Jay Powell said kind of that is not
so again. So we've seen a higher amount of people, a higher amount of jobs being added, which means that essentially the economy is slightly weaker and the Fed need to do a lot more. No, sorry, the economy is stronger, so the Fed need to do more in order to make the economy weaker, and that's why we're seeing this big drop to the downside with Bitcoin. Now, also, let me just bring this out. I know that AJ would have gone through this, but we also have to consider we're looking at some bigger patterns here. We will see a little bit of move to the upside, guys, because the RSI is extremely low, but that's going to, take probably 5 minutes for this whole news to carry out. I'm going to keep playing this.
Worried about, as they were in the past, but I'll bet you, John, that wages number has got Wall Street's attention.
Oh, Mike, this one's easy to interpret, isn't it? Equities down, lower, negative by 1.4%, negative 1.5. If you want to round this one down on the S&P 500, futures softer, yields higher, much higher, by about 10 basis points to the front end on a 2-year, back to 432. On a 10-year up 9 basis points to just south of 360. And as you can imagine, with equities down and yields up, the dollar stronger, dollar index top up by 0.5%, upside surprise on payrolls, upside surprise on wages, down. Equities down.
What a great day to have Jeff Rosenberg with us and Governor Krosner with us. And Mike, I know is diving into the data. I got 2 quick comments. My quick calculation of the 90-day, 3-month moving average, including revisions. Don't hold me to this, folks, but I believe the statistic is 280,000. And the others, can we have a moment of silence for Ben Emmons?
Okay, quick point here, guys. What we're seeing on the screen here is 2 10s. The 2 and the 10-year yield, okay? So this is very much inverted. This is something I wanted to talk to you guys about anyway. So just let me bring this up. This is the same. Let's bring up, I don't know, the US 500. So this is the S&P 500, okay? We're all very, very familiar with this. Let me just make sure. So we're going to a monthly time frame. Zoom in a little bit. If you guys have any questions, drop them in the comment. But yeah, like you said, it's taken a nosedive. It's really not looking good here, guys. And also, I want to keep this relatively quick. Don't want to keep us, kind of bogged down for anything too. Oh, mate, sorry. AJ, you're going to hate me, but I don't care because I'm using your charts. I'm proper messing them up. Whoops. Right. So to make my point here, this is why it's well worth it. Okay, I want to talk about the US 10 the US 10-year versus the 2-year yield. You also have a metric onto the US 10-year versus the 3-month yield. This is the 3-month yield. Okay, so typically what you would anticipate is if you think the economy is going to keep going in a straight line to the upside, you're generally going to want to have you're going to want to have a higher return for your money over a longer period of time. So you expect the 10-year yield to be higher than a very short period of time. Because if I let you borrow, I don't know, £100 or $100, 100 dirhams, whatever. If I let you borrow 100 currency, right? If you say, I need it for 2 years, I'll be like, whoa, okay, well, I kind of want that money back. So I'm going to charge you, maybe I want $200 back, or I want 200 of this currency back. But if it's only for like a week, I'll be like, okay, it's fine, just give me like 10, So you want a much smaller return on these shorter term lending, basically. Now we get an inversion of this yield curve because the yield is essentially how much money you get back from putting your money into a 10-year bond or a 2-month bond or a 2-year bond or a 3-month bond, whatever the bond is. You can buy different durations, different whatever. But when we see that there's more of a return for a 2-year bond than there is for a 10-year bond, so you get more of a return for staking or giving your money to the government for just 2 years versus 10 years, that shows that why would they give you a really high return over the course of the next 2 years? Is it because there's massive financial recession coming in? And this is why we or the general market looks at bonds to understand what's going on. Okay, so the bond market kind of prices things first, and then the rest of the stock market, crypto market, all kind of learn from what happens within the bond market. It's the biggest market in the world, and so this is why it's quite popular. Anyway, my point being So when we see the shorter term yields garner more a higher yield, this is where we know that there's a recession or there's some kind of issue. And we can look through history. Okay, so looking, this is the 3 month, this is the orange one, and this, you know, the normal chart is the 10-year. Okay, so when we see this inversion of the yield curve, okay, because the yield on a 3 month, you know, you give the money away for a much lower amount of time, so you're going to get less of a return. Okay, but obviously, so the 10-year, it's higher because you're putting the money away for a longer period of time. Clear, we're done. We covered that off. Now there's an inversion. This is where we're looking and we're like, okay, well, actually, that's not good. If we then have a look, well, this was in, first inversion happened June of 2000. Okay, June of 2000. Let's scramble back. What, that's not, oh, why does that not have, oh, 500. US 500. Why index? I just want one that's going to have a lot of data. Why do these not have any data beyond 2018? It's the S&P 500. All these brokers are rubbish. Let me see if I type in that. Vantage. What? Oh, this is one of those things. Of course, I should have researched this, shouldn't I? Okay, here we go. Lovely. We don't, yes, okay, this is good. This is good. Don't you worry. Right. So we'll get this. We'll get rid of the RSI. See you later. Mate! And I hope I'm not being, am I being stupid here? Why is there not data that goes back to like normal time? S&P futures? How can I not find data? All right. That's not good. I will get it. I will get it. My whole point here, as you can see, is whenever we have this inversion, okay, let's go for a more recent one. Let's go more recently. Okay, a small inversion here in 2019. Okay, 2019, small inversion here, but then obviously we had COVID. No one really could have, you know, appreciated that. Now we have this inversion again. But my point being that we have the beginning of this inversion in 2006. Okay, 2006 is when we get this first inversion of the 3 month and the 10-year. Okay, now we all know in 2006 that's not when the great financial crisis happened, is it? So 2007, we know it's burning, it's coming up, but it's only then once we get this flipping again where the 3 month comes under the 10-year, this is where we begin to see massive pain for the US economy. And I know that this isn't, you know, the S&P 500, this is not, you know, the exact stock prices, but you can see the yields fall because everything basically fell at the same time. And I'm determined to bring this up. US 100, no, US 500. Sugar. SP 500, let me just go on. SP 500, Standard and Poor's. Can't get any more basic than this. Hit me. Oh, mate. I think I'm having a mare today. All right, ES minis. Bring me back. Bring me up to the maximum. I want to see 2000. On 2000, oh, mate. Let me just look at charts. Is that too much? Right. Well, that's a bit, that is a right old mess, that is, isn't it? Okay, but I think my point still stands. I think my point still stands. Right. So inversion, as you can see over here, happened, mate. I'm having a mare. Happened July 02, July 2000. Okay, July 2000. The inversion first happened. Actually, let me just go back, and then we see it kind of finish around February 2001. So February 2001, we're here. The market still sees quite a substantial downfall, as you see here. And I know it doesn't look great, you know, but February 2001, we're right up here. That's where the inversion finishes. The 3 then goes to a lower rate than the 10-year yield. And so we then see this massive push down in the markets. Again, we'll have a quick look through 2006 just to reiterate. The yield inversion finishes in July 2007. Let's go July 2007, June, July. Well, okay, yeah, close enough. You know what I mean? But it's basically here. then we have a little bit of a pump to the upside and massive push to the downside. This is one thing that's kind of worrying me. I had a look at this and it just doesn't really give me too much confidence. I will also just have a quick look at the 2-year. So this is looking at the 3-month. I will add on here the US, I want to say 2-year. I can't. 02. Yes. 2-year government bond yields. And again, we still have this same kind of inversion. You know, a lot of people have spoken about it recently. We've been inverted for quite a while, and this doesn't really look very good ever since what, February of early this year. You know, been kind of going back and forth, back and forth. But ultimately, look at this level of inversion here. So that's a whole, almost a, you know, a whole percent. So overall, you'll get more money if you lock your money away for the next 2 years, which isn't good. And so this means that we could be in for a really big recession, but also a massive crash within the stock market. And obviously, that's then going to feed into the likes of Bitcoin. And so, you know, we could potentially see another leg to the downside. I do think, let me just zoom in a little bit here. I think that we will end up seeing something along the lines of exactly what AJ has been saying here, that we probably won't hold these levels. What we have to look at is where's the next level of support? Like, what are we currently, you know, hanging our hat on? You know, there isn't really much, especially around these regions, you know. Yes, there are a couple Fibonacci levels, but we're pretty much looking to this level down here to be a little bit of support. And again, you see a little bit around here. So I genuinely think that we might be seeing a little bit more movement to the downside. And I don't feel very good throughout the rest of this year, early stage of next year. You know, we still have worries about the US economy. I'll jump back onto Bloomberg and just kind of see if they're mentioning anything else. But obviously, the Fed are now worried because we have the likes of a super strong job market. So that's just my thought overall, guys. I feel like I've been rambling like absolutely mad. SPX, mate, yeah. The SPY, they don't call it the SPY for nothing. What an absolute loser. SPX. But yeah, so here I am, bloody going on Yahoo Finance. What what a noob, innit? I've let myself down there, haven't I? I would take the L. I would take that L. I don't mind, guys. I'll take it. I'm man enough to do it. Yeah, I've ruined that. But anyway, so yeah, if you have any questions, just let me know because you know, looking at this metric, oh, I've just got rid of it now. But yeah, looking at the inverted yield curve, I can just just have a quick look. Inverted yield curve. Also, I've got to be careful. I search a lot of stuff when I'm online with you guys. Like I'm like investing.com or stuff. My search history comes up like mad quick. And so, you know, I got to make sure I'm not looking for like inbred stuff. But anyway, so yeah, overall, I want to see how this is going to change actually, you know, because we've just had a really strong jobs report. And although Jerome Powell did previously say, right, he did say, yes, we're looking to have, let's say, not as strong. They want to kind of taper back on the rate hikes, but the duration is not going to be changed. So we are anticipating, you know, rate hikes to continue for a long time, but we could end up, especially if we continue this 3-month and 2-year against the 10-year, if these yields continue to be inverted, we have historic signs that show that we're in for a really, really bad time in the stock market and also in crypto and everything. So everything could crash quite drastically. So that might encourage him to actually take his foot off the gas a little bit more. Or because we've had a strong jobs report, he might just be like, all right, now let's just squash it, you know. But I think doing that it does invoke wider risks, you know, of a massive recession. Because obviously, you know, once stock prices go down, then you know people start buying back their own stock because it's really cheap. And so, you know, a company will buy back their own stock, which, you know, they typically do that over paying good wages, and they blame it on a recession, etc. So yeah, so I think that we will see more, you know, negativity across the next couple of months. Yes, Bitcoin has been doing well. Let me just bring up coin market cap. Yes, Bitcoin has been doing well over the past couple of days. Why am I doing that? I've got the bloody chart here. But also on the 1 minute. So it has been doing well over the past couple of days. You can see here, just like I said. So, you know, obviously I did mention RSI is really, really low, and it's quite a big drop to have. So we will see a bit of, you know, movement to the upside. We did see this, as I just mentioned. And so, you know, but it's a breath, you know. We're breathing to the downside. You know, we breathe out as we do an exercise, we breathe in to get some energy, and then we continue pushing. So it's very much, you know, that's the kind of way I think about it. We will always see these quite slight corrections, etc., of people trying to get a little, you know, a quick little, maybe probably scalpers, to be honest, probably scalper traders. But it'll be interesting to see how the general markets kind of how they react to this, because I'm pretty sure in the US there's another 1 hour until the stock market opens. I could be wrong. Let me know if I am. I am in what's his name? Dubai. So I don't know. And I know that like over here we don't have time savings. You know, you have like, you know, the clocks go back or forward in Europe. Always used to be the case in the UK. But over here, you know, they don't have that. They didn't have a war for some reason. Or no, two of them. That was why the clock started changing back. But anyway, guys, I'm rambling now. I'm going to head off. Thank you very much for watching. What I will do, Simple Technology, is I'll get AJ to do that. He's much better at TA than I am. You know your strengths and all that, and that's not one of them. You know, like I can read charts and whatever, and you know, it does enough for me to trade. But overall, I think it's better to just leave it in his hands, I should say, not in him. That would be weird. We don't like to do stuff inside AJ, unless he asks. Check it. But anyway, yeah. Look, overall, guys, we went through the 2 and the 3, the 3-month and the 2-year yield inversion with the 10-year. We have strong jobs report, a really strong jobs report. Just to kind of clarify here. So first Friday, I believe we have another CPI data actually as well. I believe we have another CPI data. So that is also going to influence what we have coming up. Let me just quickly check. ISM manufacturing, that's coming out in a couple of days. I believe that's early next week. Overall, last week we had a ISM manufacturing. This is non-manufacturing. Manufacturing. What this showed us last week was actually that essentially, you know how like, you know, if in an economy, if people don't buy goods, then the people who sell the goods don't order more goods from the people who make the goods. Okay, so you have goods when everyone started running out of money because, you know, Jerome Powell, he said, look, interest rates are going up, you can't buy houses, you can't do this, whatever. So people's spending has gone down. So as spending goes down, people make less stuff. And the stuff that comes from service providers, consultants, comes from you know, cleaners, or comes from people who make stuff, you know, the service is providing, I don't know, a platform or providing whatever. Anyway, so we see a knock-on effect where that will start to be affected, and that's already been affected. We got a negative number, I believe it was yesterday. I want to say, let me just do this. ISM manufacturing. Yes, so this came in at 49 as opposed to a forecast of 49.8. So this shows a negative sentiment in the kind of goods sector. So we're not looking forward to that in the manufacturing side of things, because this again is going to be another hit to the economy. Very, very good for Jerome Powell. And, you know, once they start making like laying people off, it will be good, you know, for the market. But we are going to go into this recessionary period over the next couple of, like, I don't know, maybe the next couple of weeks, maybe 2 months or so. So a bit of strength in the dollar, obviously, because of the jobs report, strong economy. We like that, good GDP. So that means the DXY is going to go up. Another reason why Bitcoin might go down. But then also we have GDP coming in from Europe next week. So given that that's an uncertainty, given that that's an uncertainty, people might be moving money into the dollar just to, you know, mitigate holding their money in euros, where they could have a negative GDP growth or whatever. So it could be bad news. And then finally, yeah, we've got the PPI. And then the Michigan consumer sentiment. This is just the sentiment. So this is like, hey guys, you live in America, you buy stuff every day. What are you saying? Do you feel happy? Do you not? Do you think everything's expensive? Is the world going down the toilet? But anyway, that's everything from me, guys. Thank you very much for watching. If you did enjoy the video, make sure that you like it, and also make sure that you subscribe to the channel if you haven't already. Thank you very much. See you later.